Good afternoon, ladies and gentlemen. Welcome back to this weekly market review. I have my co-host with me today, Mr. Gerald Wong. Gerald, how was your weekend?
The weekend was good. Had a bit of a rest after a very busy week in the previous week, and hope to be able to share some of our research with you over today's session.
Yes, so although last week was a short trading week, we have a Deepavali holiday, so there's only 4 trading days. But then a lot of developments in the market and of course some updates on the specs as well, which Gerald will touch on later, right?
Yes, that's right. So let me go through what has happened in the market first. Then we'll look at some of the key movers in the Singapore market before we go on to discuss specs. Okay. So as usual, today's sharing is for information purposes only. It should not be taken to be financial advice in any way. We have our SIAS session that is coming up next month on the 13th of December. So there's an opportunity for members of SIAS to be asking us further questions around whatever has been discussed in the weekly market review. Okay, if you find the webinars useful, do leave us a review on Google, either by scanning the QR code or by going to this link that is shared. Okay, so you might be asking, how do I join SIAS as a member? You can go to this website, and the membership for SIAS costs $12 per year or only $1 per month. Okay, so without further ado, I will do a quick recap of the market. So once again, we saw that the STI has lagged the very strong rally in the US market. The US market continued to rebound with the S&P 500 up by 2.2%. Okay, Nasdaq saw further gains of 2.4%, led by a lot of the large cap tech stocks. Okay, so what is actually driving this rebound in the market? The key data point that came out last week was the US Consumer Price Index data. Okay, so this is something that we shared earlier that we are looking out very closely for because it gives us an indication of inflation in the US as well as whether the Fed might hike interest rates further. So what we saw here is that for the month of October, we saw an easing of the inflation to just 3.2% compared to the previous year. So this was slightly below market expectations, which actually led investors to expect that the Fed might potentially stop raising interest rates. Okay, so how is this being reflected in the market? We see that the US 10-year government bond yield continued to fall. Okay, at some point, if you remember, we mentioned that the US 10-year government bond yield has gone up to above 5%, and that would mark the highest level since 2007. But since then, we have seen a steady decline in the US 10-year government bond yield. First and foremost, it was from the Fed meeting earlier this month, where investors gained confidence that the Fed might stop raising interest rates. And with the additional data that's come out, including the inflation data last week, investors gain even more confidence that maybe the Fed will actually stop raising interest rates. Okay, so this is a key data point that we continue to keep a close lookout for because effectively it would have implications for the stock market as well. Okay, so earlier I shared that investors are gaining confidence that the Fed will stop raising interest rates. Is this something that I just came up by myself, or do I actually have some data to be able to support it? Okay, so once again, I'll bring you back to the CME Fed Watch tool, which gives us some indication around what traders are pricing in for their expectations of the Fed fund rates. And if you look at this chart, effectively what you see here is that for the upcoming December FOMC meeting, effectively traders have priced in 100% probability that the Fed will keep interest rates unchanged at 5.25 to 5.5%. Okay, so it's quite rare that you see this 100% number, but this is really what appeared when I checked the website yesterday. So investors seem to be very confident that we will not see any further rate hikes in the December meeting. And likewise, this is what we see for the January meeting as well, also 100% that it will stay between 5.25 to 5.5%. In terms of the rate cut, effectively what investors are now looking at, it will be likely in May 2024, where 48% probability that it will be brought down in the May FOMC meeting, versus 40% probability that it will be kept at current levels. Okay, so this is effectively what we mean by investors gaining confidence that the Fed will stop raising interest rates. Okay, so next we move on to the Sing market. We actually saw a continued rebound, even though it is not as strong as what we saw in the US market. But Genting Singapore actually bounced by 10% after they reported their third quarter results. SETS up by 5.9%. CapitaLand Invest 5.1%, and we see a continued recovery in the REITs, with Mapletree Industrial Trust up 4.6%, and CapitaLand Ascenders Trust up 4.1%. Okay, I'll go on to touch a bit more about what is driving the rebound in the REITs later. Okay, in terms of the worst performers, we see Imperador down by 1%, Singtel 1.3%, DBS 1.4%, SGX 1.8%, and Yangzijiang 2%. So effectively, we have seen that some of the rate-sensitive sectors, such as the banks, have started to come off as this expectation around further rate hikes actually gets diminished. Okay, so I actually asked the investors what they actually wanted to hear in terms of the key movers in the Singapore market. And in terms of what seems to be trending, apparently investors are very interested in getting an update on OCBC, SIA, as well as Keppel DC REIT. So these are the three that I will go in more detail to touch about today. Okay, so in terms of the news flow, OCBC actually announced that they are buying Commonwealth Bank of Australia's stake in its 99% owned Indonesian subsidiary, PT Bank Commonwealth, for about 220 million Australian dollars. Okay. For SIA, we saw an update on their passenger traffic where it continued to rebound, 24.5% compared to the previous year, and cargo load 7% up compared to the previous year. Earlier, we saw that some of the REITs were the top gainers, and I think there's been a lot of interest and questions about Keppel DC REIT as well, which also saw a rebound of 5.1% with the decline in government bond yields. Okay, so I'll touch a bit about Keppel DC REIT as well. Okay, so let me start with OCBC. So this is effectively what we see. Effectively, the stock saw a peak in its share price somewhere around August this year after they announced the first half results, reaching about $13.30. It came down thereafter because of the concerns around a potential recession, because investors start thinking that, oh, maybe interest rates will stay higher for longer. We have seen a rebound, especially after the third quarter results, such that it's now back to around $13 once again. Okay, so what actually came through at the third quarter results? We saw that the company reported an increase in net profit, both in the third quarter as well as the 9 months of 2023 compared to the previous year. Okay, so this is something that the company has actually shared, that it is the first time that in the 9 months of the year, their net profit has exceeded 5 billion Sing dollars. Okay, so strong profit reported that actually lifted the share price. Okay, so what is driving this higher profit? Effectively, if you look at the net interest income, effectively it has reached a new high. We saw that the net interest income was at 2.456 billion in the third quarter of this year. Okay, so that will bring the total net interest income for the 9 months to 7.2 billion, a significant increase compared to the previous year. If you look at the net interest margin, effectively, it has reversed the decline. What investors were concerned about is that if you look at the net interest margin trend, 2.31% in the fourth quarter of 2022, but coming down to about 2.26% by the second quarter of this year. But in the third quarter, it managed to stabilize and in fact go back up slightly to 2.27%. Okay, so that was something that investors probably was positive on, and that led to the rebound in OCBC share price. If you look at the fee income for OCBC, this will come through from different things such as your investment banking services, your wealth management services. It was strong in the third quarter as well, such that it is the highest level in the last 4 quarters. Okay, and if you are concerned about maybe non-performing loans, the good news here is also that the portfolio quality is resilient, with the non-performing loan ratio at just 1%, effectively coming down from where it was in the previous quarters. Okay, so the latest news, effectively OCBC would be buying the Indonesian subsidiary of Commonwealth Bank of Australia. So what does this actually mean for the company? If you look at their current loan breakdown, you see that Singapore is their largest exposure. It has got a sizable exposure to Greater China as well, and then smaller exposure to Malaysia and Indonesia. So with this acquisition, effectively what OCBC would be able to do would be to grow its exposure towards Indonesia. Okay. So in terms of the valuation for OCBC, currently at about 1.15 times price to book, because we see that the share price has been fairly resilient. So this is actually above its historical average price to book valuation of 0.9 times. Okay, so in a nutshell, this is OCBC. Next, I'll move on to talk about Singapore Airlines. So for OCBC, we saw the strong share price performance, but for SIA, effectively after reaching a peak of about $8 sometime in the middle of this year, the share price has come off. Okay, so what is driving this weakness in the share price of Singapore Airlines? Okay, so first and foremost, we look at the first half profit. Effectively, that still continues to be very strong. In fact, in the second quarter of the year, the company reported a record quarterly operating profit. So for SIA, they have a March year end. Effectively, for the fiscal year second quarter, we are looking at the quarter ending September. Okay, so record quarterly operating profit for SIA. Okay, but effectively what we see here is that if we were to look at some of the indicators, they have come off slightly from the peak. Okay, so effectively we look at this indicator, which is called the passenger load factor. Effectively, what it is now in the fiscal year second quarter, it is now at 88.6%. Okay, coming off from the fiscal year first quarter, where it was at 88.9%. Okay, so after the very strong rebound that we see with the reopening, effectively the PLF has stabilized in the last quarter. Okay, and I think if you look at the cargo business, effectively the cargo yields continue to soften in the second quarter of the fiscal year. So effectively, that is driven by the fact that we don't have the supply chain bottlenecks anymore. So the yields have come off slightly, even though they are still below where it was prior to COVID. Okay, so the other factor that investors might be keeping a close lookout for would be the impact of oil prices. This was one of the factors that led to the correction in SIA share price earlier, especially when oil price bounced to above $90 per barrel. So if you look at the cost breakdown of SIA, the fuel cost would be the most significant portion of its entire cost base. But what the company can potentially try to do to be able to offset some of the volatility around oil prices would be to hedge it such that it wouldn't have a one-on-one direct impact towards its cost base. Okay, so that in a nutshell is a summary of SIA. Effectively, what we have seen is that the passenger load factor has come off slightly in the latest quarter compared to the previous quarter, and the cargo yields continue to weaken, and investors are keeping a close lookout in terms of how the oil price fluctuation will affect its operating costs. Okay, so last we come to Keppel DC REIT. effectively it's come off from September levels about 220, hitting a low of below 170 per share, but having a rebound such that it's now at 187. Okay, so once again, we look at the third quarter earnings for Keppel DC REIT. What probably disappointed investors is the fall in their distributable income as well as distribution per unit. So what we see here is that the distributable income came off about 6.5% in the third quarter compared to the previous year. Actually, if you look at it, the gross revenue increased compared to the previous year, but because the finance cost came up very sharply, which is why the distributable income actually came off. Okay, but what is driving the resilience in the revenue? If you look at the portfolio occupancy, it remains resilient at 98.3% as at 30th September of this year. Okay, but what effectively concerned investors would be this higher average cost of debt because it has gone up to 3.5% in the third quarter of this year, which is a 20 basis points increase compared to June 2023. If you look at the aggregate leverage at 37.2%, once again, an increase of 90 basis points compared to June of this year. Okay, so if you look at the dividend yield of Keppel DC REIT now offering a dividend yield of about 5.3%, which is slightly above the historical dividend yield of 4.4%. Okay, so I've done a quick recap around some of the key movers in the Singapore market. So once again, what do we look out for in the week ahead? So we are done with the Singapore results reporting season, but there are still some US stocks that are going to be reporting this week. What investors will be looking out very closely for will be NVIDIA. They'll be reporting on Tuesday, 21st of November. We also have quite a number of webinars that are coming up this week that might be of interest to you. So first and foremost, if you are a shareholder of VTech, there's a webinar that would actually inform you around what you need to know before the EGM, and that's happening this Wednesday on 22nd of November. We also have a webinar this Thursday where we'll share with you an introduction towards ETFs or exchange-traded funds. Okay. So last but not least, regarding to specs, I wanted to share this website. So if you would like to get independent research reports on VTech, they are now published on the SIAS website and you can access them via the QR code that is shared here. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis around the key markets. Sunny, over to you.
Okay, thank you, Gerald, for the very in-depth and insightful sharing on some of the earnings results of our local companies. And I'll now touch on some of the major indices. Let's start with our local market first, the STI index. So the STI index has been pulling back since we reached a peak of around the early part of November on 6th of November. Okay, so we said earlier that this is the support zone that we are looking at. We are seeing that there's a lot of support here and buyers will come in here. And during the end of October period, we see that it forms a new year-to-date low on the Straits Times Index. And then we had a bounce on the 27th of October. So now the STI index is being kept at this downtrend line, connecting the peak in August, as well as the peak in September, and then retested in October, and recently in November again, we tested this, and the index is being pushed down again. So where is STI likely going to head towards the end of the year? I believe if the index were to come down further towards this zone again, or even breach the year-to-date low that we saw in March this year, it will be a buying opportunity again for traders or investors looking to invest in the STI index. Okay, so this low around here, once it breaches the March year-to-date low, we will come into a support zone or a demand zone that I would say. And the second support we will be looking at will be this line over here, this blue line, which is the June low of last year, June low of 2022. And of course, the year-to-date low that we observed in late October is the December low in 2021. So if we breach the year-to-date low, I think I would accumulate here again. But then I do not think it will breach the downtrend line that you see here this year maybe, because towards end of the year, trading volume will get slowed down and market become a bit quiet. But this area looks like a zone of accumulation to me for me to set up or prepare for next year. So if let's say the results or the economy performance were to be stabilized and perform better, we may have a breakthrough in the STI index, and hence this is my accumulation level for now. And looking at this downtrend line with a uptrend line or a horizontal support, it looks like a descending triangle forming, and we are looking for signs of a breakout that would happen. But looking at the MACD indicator now and the RSI, both are pretty neutral and weak right now. Hence, I do not see in the near term, the next few weeks, we are likely going to see a breakout above this downtrend line. So this is a time where STI go into a consolidation mode and could be an opportunity for accumulation for further to see how the markets will perform towards the next year. And then if we can have a breakout above this downtrend line on the STI index. Okay, next, let's move to the US. So Dow Jones Index, we have touched on this last week as well. And we are still testing this sort of a mini double top formation on the high of September, as well as the early part and the middle part of September. So this line is still a major resistance. So I'm not surprised that Dow Jones has not moved much since we talk about this level for the whole of last week. So where will the Dow Jones likely head for now? I think looking at some of the major catalysts that will come in, we are expecting another FOMC announcement in December, which Gerald shared with us just now, that the CME Fed Funds futures pricing has already priced in 100% chance that we will not see any rate hike or any rate cuts, and it will stay at the percentage that we are seeing now. So there is I would say there's limited upside to it. And if that will be proven to be true on the announcement in December, then it may become a situation where you buy on anticipation and sell on the news at once it confirmed. So it may retrace back to the triple top that you see here, which is a resistance level previously in the first half of this year, may have a change in polarity to become a support level, thereby we cover the gap that happened somewhere on the 14th of November. And this is the next support that I'm actually looking at. So as we go into the next few weeks, the moving averages might also catch up, might also move up. As you can see, the trajectory is now moving upwards to come and support this level as well, which is the 34,281 points level. And that is one of the first entry level that I'll be looking at if, let's say, I'm going to be agreeing with what the market is saying, that next year is going to be a better year going ahead. But just to draw some similarities, last year we see the October low. And this generation here was that in the middle of this year, we may be seeing a rate cut kind of happening, but then the inflation data did not really materialize to say that we are on a very firm track of coming down. But the projection, as what Gerald shared earlier, is that middle of next year, May or June, we might see a rate cut happening. So this is a same kind of scenario, I would say, happening last year. But definitely, as of now, this level over here is at the resistance level. So I'm not going to go in long at this level. I'm waiting for a pullback. And any pullback towards this level, the red line here, or even the moving averages, or even if you want to look at the double support that you see in the June and July period, would be the area that you should be looking at to get back into the Dow Jones Index. Of course, like I said, for the STI index, going into the end of this year, it will be quiet, especially after the FOMC announcement in December. So I do not expect it to go and retest the double top or even see the near-to-date high in the near term. But probably this is a sort of an accumulation for next year going forward. Next, the S&P 500. Okay, S&P 500, the resistance that we talked about last week was the high on 1st of September. That's around the 4,541 points level. And we are about 30 or 40 points away from last Friday, close towards that level. So we have a bit of space to sort of a spike upwards again. But as you can see, the RSI indicator is reaching the point of a overbought level above the 70-point mark. And as we learn from history on the June period as well as the July period, we start to see some pullbacks around those zones where the RSI starts to breach above the 70-point level. So same thing over here. Once the RSI breach the 70-point level, which means it's overbought, I will wait for a pullback before considering any re-entry into the S&P 500. The double top that you see here may be too early and there's still a gap to be covered over here. So I believe the safer level would at least be this double top that you see in October, which can have a change in polarity. Below that, we also have a support level, which is the low in August that shows a very significant support or jump over here. So this is the first, this is the support zone I would see for the S&P 500. And it may also coincide with a very long-term uptrend line connecting the low of October last year, as well as the low of March this year. So this is, I'm waiting for a pullback to happen before getting any re-entry into the STI or even the US market right now, even for the S&P 500. Okay, next let's move to the Nasdaq Composite Index. Same thing. We have been testing this high in September, the 1st of September high around the 14,149 points level. I'll just round it off to 14150, and that's about 25 points away from where we closed last Friday. So a very narrow gap, and that also means that the risk and reward ratio, if you want to go long here, is not in your favor. So you should always wait for a pullback for a re-entry, and you can look at, of course, the longer term uptrend line connecting the low in December as well as March of this year, which is this green line upwards, this uptrend line, which may also find a confluence or coincide with the moving averages, which you can see are pushing upwards very strongly now. Okay, so this will be a sum of the two indicators pointing in the same direction, giving you more confidence of getting back into the Nasdaq Composite Index. Some of the key levels to watch out for, we have a mini double top here in the June period. So this is a resistance level. It may have a change in polarity. After that, because Nasdaq Composite is very volatile, you may also look at the August low at around the 13,500 points level, or 13,400 points level, I would say, which is the 20 days moving average as well as the 50 days moving average in blue, these two lines. The low in the August was 13,161. So all these levels here, the moving averages of the 20 days and the 50 days, as well as the low in August, would likely provide some support for the Nasdaq Composite Index for traders to accumulate here or get in here to ride on the long uptrend again for the Nasdaq Composite Index. So that is my coverage on most of the major indices this week. As we can see, the level right now for the US index as well as the Singapore index may have fully been priced in already, and there should not be much more of a surprise going towards the end of the year. And markets do look a bit positive right now. And Gerald, I'm actually looking at the markets and I'm expecting maybe we are going to see a bit of a Santa Claus rally going into the end. What do you think?
I think regardless of whether a Santa Claus rally or not, everyone is already in some form of a year-end mood. But I think we can also take this time to learn and enrich ourselves around investing. So I guess that is where some of the webinars that we have coming up in the coming weeks, including those that I've highlighted earlier that are happening this week, might be helpful. That will effectively be our best gift to you as we actually go towards the year end.
Yes, equip yourself with this to make use of this webinar organized by SIAS and get yourself equipped with all these skills to make your investing skills better, and then we will have a better trading experience going forward into the next year. So Gerald has shared the upcoming webinar we have for this week. For myself, I have the Corporate Connect for next Tuesday with Elite Commercial Trust. So do look out for that as well. And going towards the end of this year, I will be clearing some of my annual leave. So Gerald has kindly agreed to help cover the weekly market review when I'm on leave. So don't be surprised if you do not see me on the weekly market review in December. I will still be back on 13 December for the SIAS to answer the questions from our members. I will not leave our members hanging, and I'll be away in December. So I'll be back on 13 December. So don't be surprised that if you don't see me on the weekly market review or the weekly technical analysis in December, I will be back in January. It's been a long year. Okay, I'm looking forward to this annual leave that I'll be taking in December. So I think that's all the time that we have for this weekly market review. As usual, his name is Mr. Gerald and my name is Sunny. We will see you again next week in the next weekly market review.
See you.